Good afternoon, friends. Welcome to Moneyworks4me subscriber webinar on the biggest thing to happen to 10-year X-ray. I request our friends to please let me know if they can hear my voice clearly through the chat window. The chat window is at your left-hand side corner. You can type whether you can hear the voice clearly. We have substantially changed the way the 10-year X-ray now works at Moneyworks4me. Uh, I will take you through the logic of 10-year X-ray with you in during this presentation. How the changes uh, would look now in the website. We'll also discuss few of the companies wherein there has been a significant change in the color rating, so that you can understand how our thought process is, and I can easily communicate to you how we think about 10-year X-ray as of now. It's still at the broader level still stands for the same thing. We want to look at companies that over 10 years have had consistently very good performance within our portfolio. We would like to have these kind of companies within our portfolio. Once I'm finished with the next, company has to create value by investing capital that they raise, whatever they earn from investors, to generate future cash flows. Now the future cash flow that they generate has to be at the rate that is higher than the cost of capital. Now I'll take you through this whole statement throughout this presentation in each and every part, so that it's very clear what this statement really means. uh, the second guiding principle as the second guiding principle that we have is anything that does not increase cash flow effectively does not create any value. So many a times you'll see some companies who have very good earnings, but they have not had very high cash flows, very high sustainable cash flows. Then we must understand that these kind of companies cannot create value for our shareholders over a longer period of time. I'll take you through the each part of the guiding principle during the course of my presentation. Now, how can companies do this? In order to achieve value and create value sustainably, they need to do two clear things. One is they need to increase their revenues. Faster the increase in revenues, the better it is. But it should also be that the capital that they deploy should consistently earn a very good return of rate of return. uh, High growth in revenues but very low rate of return, the way typically you will see in some companies that are focused in infra, some companies that are focused in retail industries, who are creating very large revenue growth but are seeing not so interesting, so not so good rate of return. These companies will not create value if eventually their rate of return also does not start increasing as well. So in order for companies to create value, they will have to do both. They will have to increase their revenues also, and more importantly, they will also have to earn a very attractive rate on the capital that they have. Only through by doing this can we clearly say that the company has a real competitive advantage and can really create value sustainably for the shareholders. Now, what does the principle imply? Yeah, Samir, I'll try and see that at least the webinar of this presentation is shared with you. Uh, what does this principle imply? The principle implies that the company has the first primary task is it should always generate cash flows. These cash flows should be always be higher than the rate of return on the this cash flow should always be such that they are higher than the cost of capital, meaning the rate of return that the company earns should always be higher than the cost of capital. By looking at this way, we have to look at four things very clearly. Are there very strong sustainable cash flows? What is the rate of invested capital in the company? What is the cost of capital within the company? And is the company creating value? Now, each of these four things are interlinked together. Only a company that creates a sustainably very high cash flows will have a very high rate of invested capital. The cost of capital should be lesser than the return on invested capital of the company. Then only the company can create value. This is the primary guiding principle that we look as of now, and this is what we called as conservation of value. We look into in future slides when I start taking examples as to how these four link together, and we'll also look into what we mean by conservation of value. Now at the very basic, as we started, as I started saying, I need a very high return on invested capital. I also need a very high revenue growth. These together should give me a very high sustainable cash flows. The cash flows that I get should be higher than the cost of capital for the company to create value together. So the thing to take home is both growth and ROIC are important, and they together will drive value for the share. The things that we need to check are earnings and cash flows are quite many times very highly correlated. If the earnings increase, cash flows will also increase, but this is not necessarily always so, because earnings does not tells all of the whole of the story. It is a cash flow that tells the whole of the story. If you see that the cash flows are not keeping up pace with the earnings, then there is always something to be suspect of. There is always something for us to suspect the numbers that the company is reporting. Secondly, strong earnings but weak cash flows can also mean that over time the company will have to borrow to fund its growth. It cannot use the cash that is generated by the business to make its future growth. Uh, the most important thing that we always have to keep in mind is that many companies lose their plot not because of earnings but because of cash flows. I have seen innumerable companies who go bankrupt or who see their last decline in their share price or value, not because of earnings but largely because the cash flows have not been very sustainable. Uh, if as an analyst we have been looking at earnings rather than as on cash flows, then companies like Enron or infrastructure companies, then infrastructure companies uh, would necessarily come as very bullish to me because of very strong earnings. But when I start looking at cash flows, then we see that many infrastructure companies are strained today because of very weak cash flows that they have. So cash flows is the dominating part and not necessarily earnings. Now what is return on invested capital? At a formula basis, what I would look at is what is the operating or capital operating returns that the company can earn net of its taxes. This is what we call simply as EBIT into 1 minus tax rate. EBIT is basically earning before interest and tax. When earning before interest and tax basically looks at what the operating earning of the company is. Uh, Now this operating earning cash is available to both the shareholders as well as the debt providers. So we divide by the total asset size of the company to look at what its total return on invested capital is. The total asset we simply defined as total fixed asset plus working capital for our. Now the weighted average cost of capital is the cost of capital formula that we look into. As I stated earlier, that the ROIC should always be higher than the cost of capital for a company to create a consistent value. Now at a very simplistic rate, this is the formula that we look into while calculating weighted average cost of capital. Now the first part in this is cost of debt. This is nothing but just the interest cost that the company has to pay for the debt that it raises. The next is the tax paid. Now the tax rate that is applicable to company, for let's say for IT companies at least MAT is applicable, so it will be about 20%. For other companies it will be about 33 to 35% depending on the what additional taxes it is subjected to. So cost of debt into 1 month's tax rate gives me the effective cost of debt that the company has to bear. Debt is nothing but the debt that the company has raised for funding its operation, the debt that it has on its books. Now cost of equity, we'll look into it in detail. It is just the way I have cost of debt, the cost that a person or a company has to pay on the debt it has raised. Similarly, there is a implied cost of equity that the company has raised. It is nothing but just the expectations of the shareholders at an average level that the company has to meet. So on an average, if I say that shareholders, given the riskiness of the company, have and a 15% and a expectation of from the 15% return expectation from the company, then 15 percentage would become the cost of equity of the company. Equity is the market value of the company as on the date that we are looking into the company as. Now, as I stated earlier, value creation at its very basic means that the return on invested capital must be higher than weighted average cost of capital. So for value creation to really happen, this number always has to be a positive number, that is ROIC minus WACC should be a positive number. If you see a negative number of ROIC minus WACC, it simply means that the company is destroying value. To put it in real perspective, how important this number is, if the company has ROIC minus WACC as lesser than 0, then it would mean that more faster it grows, more faster it will destroy its value. On the other hand, if the ROIC minus WACC is a positive number, then the faster it grows, more value it would be created by it. Now let us look into what a business is, to put it simply. In order to start a business, you will borrow money. Either the money would be in the form of debt, that is represented by letter D over here, or it would be in the form of equity. Now the money that you have borrowed, you will invest in certain business, and this business will generate certain returns that you call as profits. This is the in the simplest form what you would look into while doing a business. But once you get returns, you have to pay interest cost on your debt at least. That is the bare minimum. But when we look into the capital structure of our business, we have not raised everything through debt. We also have certain component that is through equity. Now it is as the a debt investor looks out for a certain kind of returns, same way equity investor also looks out for certain kinds of returns over long term. Now this cost is what we call as a cost of equity, because we should remember that equity investment at the end of the day is not for free for the company to be used as it wants to use. There is a cost implied within the equity also that the company raises. This equity is not just the share, not just the capital that it raises directly from the shareholders through IPO or FPO, but it also means the profit that the company has not passed on to the shareholders as dividends, as but has decided to retain itself for funding its future growth. So this is the equity part that we are looking into. This equity part also has cost, and this company, in order to generate sustainable future value, should earn in return not just on its debt but also on its equity. Let's take an example. Let us assume that the cost of capital is just 10% and we borrow 100 crores to run our business. Now we invest this 100 crores into our business. Let's say we are building some plant which will cost us 100 crores, and this gives us about 12 crores as return. Now as I stated, the cost of capital is 10% and we have borrowed about 100 crores in form of both debt and equity. So our cost on capital is about 10 crores. Now the value that I am creating is nothing but just the difference between the return that I have generated and the cost of capital in rupee terms, in this example. So I am just creating 2 crores of incremental value, because 10 crores is just on the cost of capital, that is the capital been both in debt and equity. Let's take one more case. Again I borrow about 100 crores. Now because I borrowed 100 crores, I have a 10% cost of capital. This would mean that 10 crores of my earnings is just for covering my cost of capital. This 100 crores I have invested in business and it generates just 8 crores as profit. Now this kind of business is earning minus 2 crores as return. So this is a value destructing business, because the additional 2 crores I have to put in from my own pocket. My business is not generating that incremental value for my company to grow sustainably into future. Let's take one more case. I borrow about 100 crores for which the cost of capital is about 10 crores. I invest it in business. and it generates 10 crores. Now this kind of a company is a very special kind of company. Here the company is neither creating value but not destroying value. So in this kind of a case, it will not be the ROIC minus WACC that will dominate the valuation, but it will be the growth that the company can get, so that eventually it can generate substantially more returns than its cost of capital. Let's look at a international example. In 2007, Walgreens, one of the large companies in US, was generating sales of about 54 billions. Vigres at the same time was generating a sales of just $5 billion. Now income growth, if I look into income growth, the income growth of Walgreens was 14% compared to Vigres 10%. This is a substantially very high level of growth compared to uh, uh, and a Wrigley's as such. A 4% over sustained over a period of 40 years is not a small number. But if you still see the stock returns, Wrigley still outperforms Walgreens by a substantially good margin. Why is this so? The important part to look into is the return on invested capital. The return on invested capital of Wrigley's is effectively double of Walgreens, and this high return on invested capital is what is driving stock returns over long term for Wrigley's, or and this allows Wrigley's and a share to significantly outperform over Walgreens each year. Uh, Now the question that we beg to answer is, should we go for companies with high ROIC then? The answer is no. The question is not to put ROIC at the high pedestal and not give importance to growth. Why is this so? Uh, the bare the bare minimum that you have to always remember is, while the company can always generate high return on invested capital for its over its cost of capital, but unless and until it continues to pursue growth as its a secondary strategy over a period, in one, inflation will start eating into whatever incremental cash flows that it is generating. Second, because the cash flows themselves are not growing, the cash flow that is today has more value than cash flow that I get, let's say, a year from now. So 10 rupees that I get today will have more value than 10 rupees that I get from a year from now, just because the money is coming delayed to me. So 10 rupees that I get 10 years from now will have much more lesser value. So while, because the company is not pursuing the strategy of the growth, its future cash flows have very lesser value than what its a nearer cash flows have. So we cannot expect such type of companies to really grow at a very fast pace. So what are we saying then? Before I come to the question, let's look into a different case of example from the same industry, but those were in the different industries. The sales in 2011 for Reliance was about 2.7 lakh crore. In for ExxonMobil, it was about 370 billion dollars. The sales growth that Reliance saw was about 238%, while ExxonMobil saw a sales growth of just 6% from 2006 to 2011. Now the return invested capital that the uh, okay, Basu, I'll try and see to it that I speak slowly so that you can get the concept. Now the return invested capital that Reliance saw was 13.5 compared to ExxonMobil's 20%. Now if we just look at this, ExxonMobil continues to get a very high level of return on invested capital compared to Reliance, but still market gives a very high PE to Reliance compared to ExxonMobil. To put in perspective, both are very large companies in their own countries. Okay, they effectively dominate the stock market of their own countries to quite a large extent. But Reliance had seen a substantial growth, while ExxonMobil sees a very high return on invested capital. Yet market pays a premium to Reliance compared to ExxonMobil. Why is this so? The reason why this is so is because once return on invested capital is higher than the cost of capital of the company, the primary thing that would matter later is not how large the return on invested capital is compared to its cost of capital, but more importantly, how fast the sales can grow compared to its other peers. So because the sales growth of the company has been very large compared to its other peers, Reliance is paid a higher premium compared to ExxonMobil. So what we are saying, if I go to my previous slide, what we are saying, we are saying that return on invested capital has to be higher than cost of capital. The higher the better. But once the return on invested capital is higher than the cost of capital, you should look out for companies that have focus on growth. So your primary filter is to get a company with a positive return on invested capital or its cost of capital, that is weighted average cost of capital. Once you have filtered your companies through this, then you should look out for companies that have sustainable level of growth. So to put it simply, value creation is important. The way we define value creation is return on invested capital should be greater than its weighted average cost of capital. But once you have value creation, the company should focus on growth. Look out for companies who are creating value by having their return on invested capital more than weighted average cost of capital, and are also gonna having a good growth. Now this is the way the 10-year X-ray looks. Now the new field that we have added, I've highlighted using a box. You can have a look at it. The new field that we have added, we had ROIC before also, but now we have added one more field called as ROIC minus WAC, which looks at whether the company is creating value or not. Uh, So this particular line, the ROIC minus WAC, is the primary line item that we would now see before giving any color rating to the company. If the ROIC minus WAC has been consistently very high green number, then we would say that the company is creating value, and then we'll start focusing on the top numbers, that is the sales number, the EPS growth rate numbers, and the operating cash flow numbers. But if the ROIC minus WAC is not a consistently very high number, it has been a red number, a negative number, then irrespective of how the growth has been for this company, this company would get rated red. Let's look at some of the companies to get a better idea of what I am really saying. Let's look at L&T. Now if you look at the L&T share price, the company's share price has not done really well post 2008-9. One of the big reasons, if you look into it, is that the ROIC minus WAC, the thing that we were not looking at previously, has moved from green, a very strong green number in 2007, to very negative red number in 2010, 11, 12. Now a consistent it is okay if sometimes if a company goes through a bad cycle and it just gets a one-off negative number, but seeing consistently that L&T has been having a red number over long periods of time, we can clearly say that L&T is a company that is creating destroying value. But if I were to not see for this for some time, if I were to just see the net sales numbers, the growth, EPS growth number, we would be really be very impressed if we just see this number. The EPS has moved from 12 to 80, that is about about 7 times growth. The sales number has moved much more faster from 10,000 to about 64,000. That is about 6.5 times growth. But if you see at other few numbers, that net operating cash flow has actually been turned negative, and now ROIC minus WAC is also negative. So these ROI, and if you see clearly, ROIC minus WAC is a leading indicator. It turns an orange first in 2008, wherein the net operating cash flows has also turned negative. But in 2009 it does well. The operating cash flows are positive, but if you look at ROIC minus WAC, it is still negative. So this be the most leading indicator of when pointing out weaknesses within the industry as such. Let's look at another company, BPCL. Now if you look at BPCL, for multiple of reasons, largely related to another at the subsidized rate that it had been selling most of its produce, whether you say kerosene, whether you say LPG, or whether we say even uh, diesel and petrol, we have seen that we are seeing that ROIC minus WACC has consistently been high negative number for BPCL, and for this reason itself, BPCL continues to be just a value buy for people. People just hope that uh, someday the government will realize the folly in their thought process. They would remove subsidies on fuel, and company like BPCL can start creating their value. That is the only hope which is driving BPCL's value, share value. But otherwise, if you look at BPCL has is nothing but just has been a value destroyer as far as shareholders are concerned since 2006 to 2012. Another important way to look at it is any company that does not sustainably creates a very high strong ROIC minus WACC would also see that the debt to net profit will also start to continuously increase, because since it is destroying value, in order to just continue to earn and keep its operations running, it would have to continuously borrow or raise more and more capital. Now let's look at something better after some lots of bad stories. Asian Paints. If you look at Asian Paints, uh, if you look at Asian Paints, then consistently the company has been creating value at all line items. It was seeing a very strong sales growth since 2004 to 2012, with just an exception of 2005 wherein it saw a relatively small sales growth. But if you see at the core numbers, each of these numbers are a very good numbers. Getting a 20 to 17% growth rate is not a small achievement for any company. And if you look into EPS, except for three blips, we see that even the EPS has consistently kept up its pace. The EPS also consistently increased in number, and is more importantly, the ROIC minus WACC has also been a very strong number. Yeah, Arun Kumar, once I'm done through the presentation, I will take you through any other companies and ROIC minus WACC and their valuations as such. So if you have any doubts as far as the 10-year X-ray is concerned for any specific company, I'll take you through it. Now, if you look at Asian Paints, the ROIC minus WACC was also a very strong number uh, for the company. The ROIC minus WACC was a very strong number, and while I would not have mind ROIC minus WACC to decrease a bit from 24 that it had got in 2012, if it could get growth. But since Asian Paints is getting both ROIC minus WACC and growth, I am very happy. And if you look at this as a metric, you will see that Asian Paints continues to get a very high premium compared to its peers. Asian Paints has also done fantastic as far as share price is concerned over last 10 years. Now let's look at ACC. Now, if you look at ACC, post its takeover by by Ambuja, and its later on takeover by Holcim, you see that the company has had a very strong return on invested capital or its weighted average cost of capital. So it has been pursuing a very strong and a value creation number. But when you look at its growth numbers, the sales growth has been quite dormant to speak of. The sales growth number have not been very strong to speak of. The same thing is with its EPS number. If it's look at its EPS from 2007 to 2012, it has effectively seen not much of a growth. Now we understand that ACC is a cyclical is a cyclical company. So once the cycle starts turning around, we would certainly see that companies like ACC, who have very strong return on invested capital minus weighted average cost of capital, will start giving out very strong growth, strong value creations also to its shareholder. We'll see that the share price will substantially move much higher than what it was seeing in between 2008 and 2012. to understand how ACC would be, we would take you through HUL. Now, HUL has a had a similar problem like ACC. If you see at HUL, the HUL's ROIC minus WACC has never been a problem. Its ROIC minus WACC was always a very large number. The but the company share price in 2002 was also somewhere around 200 rupees, and in 2006 7 2006 was, it was also till about 200 rupees. So it had not moved much as far as value is concerned. What was the big weak point that the HUL was having? The biggest weak point was, while it was doing value creation, it was not generating very high sales growth number. But the moment that in 2007 the when the new chairman came in, he said that he would start focusing on growth, and it started giving initial results of a higher growth numbers compared to what it has been clocking on an average. We saw that from 2007 to 2012 it has started moving substantially at a higher pace. From 2007 to 2012 it reached from 200 to about a 500 rupees peak, and is somewhere now on 460. The current weakness is largely due to market belief that it cannot sustain this level of growth continuing into future. Because of this big reason, while HUL continues to see a very strong ROIC minus WACC, but the fact that the market has a belief that it might not continue to sustain such high growth numbers, the share price have moderated a bit. But still, since it is getting a 12% plus number of sales growth and EPS growth, the value has not deteriorated a lot either. But the question that you need to start asking HUL management is, what are their plans to get a much more higher sales growth and EPS growth number? Because as far as value creation is there, HUL continues to have very high value creation number. Even if HUL were to lose few points on the value creation side, but because in return for that, if it can clock a much more higher level of sales growth and EPS growth, it would give much more higher returns to its shareholders. Now let's look at United Breweries. Now, if we were to look at just the growth numbers, as in the sales growth number, we would see that the company has seen a phenomenal sales growth from 450 to 453 crores in 2004 to 2012 of 3600. This is about 8.5 times growth. If we look at EPS, even the EPS has grown phenomenally from 0.16 to about 5.3. So the growth rate numbers looks very good, but when I see at ROIC minus WACC, the number is extremely negative throughout the decade. And this is one big reason why we continue to believe that United Breweries is a company that people should avoid, because the company has consistently not performed at value creation metric, which is our the first primary metric, and because of this reason we continue to be negative on United Breweries. Now, the same story unfortunately runs with some real estate companies whose whose core component of strategy is to gorge on as much of land as possible, and because of this nature of their strategy, they tend to carry a very high amount of capital. The size of the balance sheet is much large. They take on land that they might not need over next 4 5 years, and because of this particular land would not earn any returns for them. And because of this nature, we see that the ROIC minus WACC of companies like DLF has really come down very drastically. But if you look at the EPS number, the EPS number was always a very good number for DLF. The sales growth was really very good for DLF. But if you look at ROIC minus WACC, ROIC minus WACC was a leading indicator, and it would have passed on to you that there was a huge problem within the DLF that was not recognized by the market initially. Now let us come to the new initiative that we have launched, that has come directly out of the uh, value creation metric that we have been looking into. What we really saw was that there would be certain type of companies like Asian Paints. They would not come down to their DP, largely because of the fact that the DP as a fact looks out for the most pessimistic outlook for the company. Now, as if the company is a very large, if the company has a very strong brand, if the company has a very strong value chain, then it's unlikely that this kind of company would easily see a negative pessimistic scenario. And because of this, companies like Asian Paints might never touch our DP. And because of this reason, what would end up happening was that many of our clients would end up buying companies which are very high risk and which see a lot of cyclicity in their business, but would not end up buying strong companies who might not see so much of cyclicity in their business, who might not see who largely because of consistent performance from their management. uh, because of this reason, we have come out with a buy sell plan. What is a buy sell plan? The aim is of the buy sell plan is see to it that on an average the company that we end up buying is an extremely good company, and we buy it at a good price and do not wait out for trying to get that one particular right price. Meaning what? Let us say that for a company like Asian Paints, if my MRP was about 100 and my DP was about 35, let us not wait for the company to reach its DP. Let us buy into the company every time I see a substantial dip into it. This is what we mean. So if it reaches DP, I would go full on into and putting a major part of my investment that was allocated to Asian Paints into Asian Paints. But if it is not reaching DP, at least let my part of my investment go that was planned to go into a company like Asian Paints. Let it go into Asian Paints. Now we are trying to create a method so that we can see that on an average, while the price at which we end up buying the company be substantially low, let us start our buying at a bit higher than our DP. The reasoning that goes is, let us buy good companies for a fair value rather than buying fair companies for a very high value. uh, Now, because of this value creation that we have introduced, we have also tried to reclassify companies under four groups, at least internally. Internally, now we are looking at four groups. The three groups you are very clear with already. One is the green company, one is the orange company, and the other is third company. But we also found out there are certain companies who have consistently created value over long term, and who have also seen a consistent and a sales growth and EPS growth performance. Now, now within so these kind of companies who have seen very high, very strong value creation, who have seen very high and sustained sales growth and earnings growth over last 10 years, we are calling them as greenest of green companies, internally at least. The reasoning being that even within the green companies, these are standouts. uh, these are very few companies. About 22 companies are what we are calling greenest of green across Indian capital markets. We have just found out just 22 companies are greenest of green. These are better than the green companies, and because of this reason, we have come out with two buy sell plan. One is for the green companies and one is for the greenest of green companies. How should you look at a buy sell plan? Think of buy sell plan just like an SIP. It is a systemic investment plan, but instead of on a time based basis, as in putting a same amount of money each month, we'll phase our money for each and a fall in the share price of this kind of company. So if the share price of Asian Paints for some reason corrects tomorrow, then we'll buy into Asian Paints. If it falls another few percent, we'll buy into Asian Paints. So for each type of company, that is the greenest of green company and green company, we have two different kinds of buy sell plan. Today, I would like to share with you the logic of this buy sell plan as far as uh, greenest of green company is concerned. Now, let's look at this buy sell plan. Let's assume that our MRP is somewhere about 100, okay, and I have about a margin of safety of 30, so my DP is about 70. and the earnings growth I'm taking is 15 percentage. Now the uh, each the price from 100 to 70 I've distributed into certain types of what we call as bucket. And now we have divided these buckets into broadly seven segments. Now from 100 to 95 there is a fixed buffer that we have kept of 5 percentage, so meaning the company's price has to fall at least 5 percentage below its MRP before we start initiating our first purchase. Let us say we decide to and I invest about 1 lakh rupees. So let's say we decide to invest about 1 lakh rupee. uh, Now only 5 percentage of this would be invested, will just 5 percentage below MRP. So in between 95 and 90 I would invest 5 percentage, that is 5,000 I would invest in between this MRP and just 5 percentage below MRP. Now, 15 percentage I would invest when the share price moves from below 90 to in between 90 and 85. Another 10 percentage would be invested. It is another 10%, not another 15. So it takes that my total invested amount would be about 15,000 now. Same way as the share price continues to fall, we would continue to invest till 75, that is just above our DP, about 45. I would have invested about 45 percentage of my investment deemed for the particular company into this. Now below this number I have two big buckets, and the if you see from 5 to 15, this there is a 10% additional capital that I am putting. From 15 to 30, another 15% capital I am putting. From 30 to 45, another 15% capital that I am putting. But from this, now I am increasing substantially the amount of investment that I am going to make. Here the additional capital is about 25 percentage that I am putting, and then I'm putting another 30 percentage at a very strong price. This last bucket is for greenest of green is below DP. The bucket just below DP is a strong buy, along with the bucket just above DP is also a strong buy. If I take it if I make an investment this way, while I start my investment somewhere around 95 on, and if the share price were to really correct, move from let's say 100 to 70, and then if it were to move up, my average price that I would end up getting would be somewhere just above my discounted price. It would be 72, it would be somewhere in between 72 to 75, sorry, somewhere in between 70 to 78. So it would be somewhere in this region. And because of this region, even if the share price were not to fall down to DP, if it were to retract but somewhere in between, we would end up getting at least some returns on a very good company, which we can keep up for a long period of time. Now a similar logic works on the sell side, but the logic that we look at the sell side is more dependent on not on the margin of safety that we had kept. Margin of safety is what we are looking for the buy, but for the sell we are looking at the EPS growth number. So let's say we were expecting a 15% growth. Now if the MRP of the company is about 100, then let the share price increase by 15 percentage within a period of 1 year. Then you would get your first sell trigger, that is at which would ask you to remove at least 40 percentage of your investment that you have made into the company. The effective logic that we are looking into is that our initial requirement of earnings growing by 15 percentage has already been overshot. The market may already been factoring in a much more aggressive growth of EPS, and because market is trying to become greedy, we want to be cautious, so we are trying to sell off the share. But still we are not selling off the bulk of it because it has just moved about 15 percentage. Let us say if it were to move another 15 percentage over and above this 115, we are again recommending another sell, because think of this as this is a forward EPS of 1 year. if forward EPS of 1 year is factored in, this is what my valuation would have been. The second sell signal effectively is looking into 2 year forward EPS of the company. If 2 year forward EPS of the company is looked, assuming same growth, same riskiness of the company, then this is what we would look into. And 3 year forward EPS, which would typically see only when the markets or the company is becoming too bullish, is when we would recommend that boss, our company shareholders or current investors are ready to pay too high premium for the growth that the company is seeing. Let us get out of it. If sometime tomorrow, if we start seeing that there is a real value in this company, we may decide to re-enter. But as of now, because the company is seeing a very high premium, even though the company may be good, we must let get out of this. I hope this plan is clear. A similar plan, but much more aggressive on the downside, so that we get a much more lower price than the DP, would be initiated for the green. Once it comes out, I would come back to you and say that try and explain the buy sell plan to you. How would this buy sell plan look to you? When you click at the timing signal on your decision maker, you will see a chart opening up. Just below this chart, you will see this kind of a simple graph over here. This graph will indicate at what price the DP is, what price the MRP is, and at what current bucket it is. Now, if you look at as far as my uh, communication will to you is, there are only two communication. Either I am recommending you a buy signal or a strong buy signal. The internal buckets or internal descriptions are being mentioned for your understanding purpose. We do not want to populate by too much of signals to you and start giving you out erroneous or too much of a precision oriented and a thought process. This is not a precision oriented. There are always likelihood of some amount of a judgment call made into it. uh, so on that basis, we will see only two buckets. One is a buy bucket, one is a strong buy bucket on the buy side. You see two buckets. Same way you see two buckets on the sell side, a sell bucket and a strong sell bucket. To repeat, the buckets on the buy depend on MOS, and the buckets on the sell depend more on the earnings growth rate. Now, on the top, in this photo that you have, in this picture that you have, it will mention and how much percentage of the amount that you had planned to make an investment into this particular company you can invest. So if we had planned to invest about 1 lakh rupees, so given this look, we can invest about 45 percentage of our investment. So if I had planned about 1 lakh, so I can invest about 45,000. If I had not done as till now, so let us initiate this position as of now. I hope this part is clear. Now I'll open the place for questions. If you have any questions, do let me know so that I can take them forward. I understand that you have queries regarding the value creation for some of the companies. Uh, let's look into these questions. Uh, okay, so one of the questions is on BHL. Let's look at how BHL would look into our new decision maker as such. Excuse me. Let's directly go into the 10-year X-ray. If we look at why we continue to maintain a buy rating on BHL is, while the share price has substantially come down, uh, while the share price of the company has substantially come down, the value creation of the company has remained extremely strong. The value creation of the company has been substantially strong. If you see at this ROIC minus WACC in your 10-year X-ray pro, whenever you go to any company, just check its 10-year X-ray pro. Now, depending whether the analyst has done valuation on the basis of standalone or consolidated basis, you will see the ROIC minus WACC in that particular heading. So if I were to look into BHL, you will not see ROIC minus WACC over here. Okay, because the valuation for company has been done on a standalone basis, largely because there is not much of a difference in between the standalone reported numbers and the consolidated numbers. So the valuation by the analyst has been done on the basis of ROIC minus WACC. Further, the company continues to report its quarterly numbers on a standalone basis. So we do valuation on a standalone basis. So if you see over here, you'll see that the value creation has been substantially strong. Okay, now yeah, we would have been a bit concerned on bail if we would have seen a sales growth degrowth or a sales fall, very slow sales growth or slow EPS growth in bail. But when you see at real numbers, when we see at the factual numbers, we would see you would see that even the sales growth of the company has been strong, not just now, even in the recent past the sales growth number has been very good sales growth number. Okay, if you look at EPS has also been doing extremely good. Yes, is there concerns with respect to bail? Yes, BHL has some near time concerns with respect to bail. We need to be very clear that BHL has BHL supplies power plants and capital equipments to power companies, and we know that power companies are going through a very bad phase. India as a whole is seeing a very low level of investment growth that is happening in power, and till this situation is rectified, BHL share will continue to see weakness. So yes, while we continue to maintain a buy rating on BHL at our price of 200 also, the thing that we need to we'd like our investors to keep in mind is that BHL is an investment that will give you returns over next 5 years. It is unlikely, I would say, unless and until we do some drastic measures, do a very large power sector reforms, allow do large and economic reforms. It's unlikely for BHEL to really outperform in the near term. So what people should really try is not to put the bulk of investment that they are trying to make into a company like BHL as of now, but should phase out over and a large percentages drop. That is what the buy sell plan is trying to do. It is trying to create help you invest so that for a large percentage drops, rather than sitting on the sidelines, we start investing in really good companies, and BHL is one of those kind of companies. Okay, I presume that people continue to have some doubts on WAC, so I'll get back to WAC. Now, what WAC is? Let us get the idea on a conceptual basis. If you raise some money from the market, irrespective of what the way you have raised the money, whether it is through debt or equity, there is a cost involved in it, which is we call as cost of capital. Now for debt, the cost is very clear. It is the interest cost that you will pay to the bank or to the debt holder, the person who has given you debt. For the equity part, unfortunately the number is not so clear number. It is the number that can only be estimated. It is a number that can only be found out on a retrospective basis. It is not a number that can be calculated using certain ratios. Okay, but to conceptually think about it is to think about what is the average return that the shareholder of this company is expecting to get from the company over a long term. Is he expecting a 15% return over a long term from this company, or because of the risk in the company he wants a slightly more higher, say 18% return on this company, or because the company is extremely good, the company is extremely strong, the company has a very strong brand, is he okay to say okay, don't give me 15, just give me 12% return, I am okay, because of the uh, uh, strong brands that you have, strong value and a chain that you have created, you have substantially less risk than an average company in your company, so I'm okay with a lesser amount of return. Now, weighted average cost of capital, or WACC, that we call, is nothing but a weighted average of these two sources of capital. You can raise your capital, that is, you can start your business using either debt and equity in any form. You can go 80% equity, 20% debt. If you have very stable business, a very regulated business, you can even go on the other extreme of very high level of debt and very low level of equity. In case if there is no debt, then the debt automatically becomes zero, so there is no cost of debt. The only cost is the cost of equity. The cost of equity is the expectations of your shareholders. For a company like say Infosys, which has no debt, it will only see cost of equity. There is no because the only form of capital that it has is its equity capital. So it would see its equity capital, and because it has its equity capital, it will see a cost of equity only. Now, weighted average cost of capital is weightage average of these two forms of cost on the capital of debt and equity. The weighted is done based on the fact whether the company has more debt or more equity. If it has more debt, then the weightage would be debt divided by its total asset for the debt capital. If the company has for its equity, the weightage would be equity divided by its total capital. So this is how we look into weighted average cost of capital for the company. Uh, uh, Now let's look into Infosys, which was another company that was within our this. Now if we see at Infosys, now if we see at Infosys, the good thing about Infosys is that just like the previous company that we saw, BHL, it has also had consistently very strong value creation, that is ROIC minus WACC number. It has had consistently very strong number. Uh, if we look into its if we look into its sales number, the sales number have also grown, but yet Infosys share price has seen a significant fall. The very big reason for it is that the market is a bit suspicious, a bit suspicious whether Infosys can continue to see this strong level of growth numbers into it or going into the forward or not. So as of today, I would say that it may have overreacted for the fall that we have seen in the Infosys. But do I suggest that people should start looking into buying into it? I would rather suggest that and they wait for some amount of time. Yeah, this is a good question. People are asking why is the ROIC minus WACC has been coming down substantially down. See, what we need to understand in this is very clear. See, when you earn some returns on your capital, let's say in our example, you earn on your 100 crores capital, you earn 10 crores as your profit. Your capital, if nothing, has again expanded to 110 crores now. So if you earn just the same level of returns that you were earning last year, the same level of PAT that you have earned last year, then your ROIC will start coming down a lot. So for ROIC minus WACC to be really be maintained, you should have that your EPS growth also starts and moving at a very high rate of growth. Okay, if only when you can see that if you see EPS was growing at a much more faster stage at the earlier part, but has moderated in the post 2008 7 8, and this has been one reason why WACC started moderating. Right minus WACC also started moderating in this for Infosys as taken as a case. Why has share price of Infosys reacted very negatively? One thing we need not forget is if you go back about 2 to 3 years back, uh, Infosys was the darling of stock markets. Every investor has always given a premium to Infosys compared to all other its peers. Now, when Infosys performance is languishing behind its peers, it will certainly see a correction. First of all, giving a premium to a company itself is a bit shaky, because if nothing, we are double counting uh, the effect that the company can bring. If let us say the company has extremely strong brands, it has extremely strong market share, it is a very capable management, then it is anyway going to see it in its EPS growth. But by giving it a premium over its peers, we have pulled up Infosys much more higher than what it should have been warranted. So yeah, Infosys has corrected substantially as of today. Does this mean that Infosys is some company that you should go ahead and look out for short? No, I would rather suggest that a few points more correction, let's say about 4 to 5 percentage points more correction over next 1 or 2 months, and probably Infosys can be a very good addition into your portfolio. But if you are trying to use Infosys through your bias through the buy sell plan of ours, then you can even start initiating position as of now. The only thing that you need to keep in mind is that from now, if you start investing into Infosys, your average price should be about 4 to 5 percentage below its current price. That is the weighted average price that we are looking into. Your weighted average price should be somewhere about 2000 rupees, and not more than that. If you start investing through thinking that, keeping that in mind, even investing into Infosys as of now would not be a bad idea, given that Infosys continues to be an extremely good company, and US is already seeing resurgence in its growth, while Europe is not. But Infosys continues to get a decent amount of earnings, decent amount of its sales from BFSI sector. Uh, we believe that going forward over 3 to 4 years, once the global economy stabilizes, things would turn out really well for it. Now, if we look at Maharashtra Seamless, uh, Maharashtra Seamless is an extremely good criteria to look into using our ROIC minus WACC. Now, if you look into Maharashtra Seamless as a company, uh, if I were to just look at its sales growth number, the sales growth of Maharashtra Seamless has been phenomenal. It has moved from 4,900 crores odd company to about 2,000 crores company. Its EPS has nearly doubled. It has very low amount of debt to speak about. When I adjust ROIC minus WACC for the cash, substantial cash position that it has, we would see that these numbers are not red actually, but these are orange numbers. Uh, Second, if you look into the company, the growth rate numbers are extremely good numbers. Now, the problem for Maharashtra Seamless stems not from because of the performance of the company as such, but because of the industry that it is going through. Uh, if you look into the company like Maharashtra Seamless, which gives a piping, which supplies to gives uh, huh? If you look into Maharashtra Seamless as a company, uh, the thing that we would see is that over since from 2009, over last 3 years, the ROIC minus WACC has also substantially come down, even though it was from a very high green number to a very low red number. But even if I adjust for the substantial cash that the company has on its book, the company is this and the ROIC minus WACC still goes to a positive orange number, but it is very less than it's in a green number. Now, if I compare this to another number of another company competitor of it, Jindal Saw, you would see that while its ROIC was very good, its ROIC has substantially fallen down. You would see once we put the WACC number also for ROIC, that Jindal Saw has actually underperformed. Jindal Saw has done much more worse than Maharashtra Seamless as far as value creation is done. You can have a look at Welspun also. Just give us about few days and we will see the WACC metric coming in for the smaller companies also. Now, why we continue to maintain Maharashtra Seamless at a buy rating is a very simple reason. While the value creation metric has been weaker over last few years compared to what it has seen historically, the reason we continue to maintain this on a buy is that as the price to book value, Maharashtra Seamless continues to be a very attractive value proposition. It is just 0.73 of its book value, and this is one big reason why Maharashtra Seamless management has come out with a buyback plan, wherein they have indicated that they would buy back share worth about 100 crores over next 1 year. Uh, since they would buy back the share at the price of rupees 300. While investing into a company like Maharashtra Seamless, we have to be cautious about whether it is same as Opto. We do not want to be cheated again by saying that the company's management had reported false number. The thing that gives us confidence, if nothing, is just that the management itself has come out with a very strong 100 crores and a buyback offer. At the wherein it is ready to pay a very high price of up to 300 rupees to buy back the share of Maharashtra Seamless. If you to put it in perspective, the share price of the market cap of the company is about 1500 crores, and when it is buying about another 100 crores, we are effectively saying that the company is going to buy out uh, about 5 percentage of its capital. Now the SEBI norms require it to buy not more than 5 percentage of its share capital in a particular year, and because of this reason it cannot do a much more substantial buyback. But this is a clear positive sign that uh, the company management also believes that it is substantially lower market value than what its liquidation value would also be, and that's why it is it very profitable that instead of putting that money that it earns back into its business, buying back uh, a share of the company would simply increase its ROIC minus WACC, because the ROIC would go up because part of its share capital will start decreasing. uh, so because of this reason, one, the buyback, second, that unlike opto, if you look at opto, while yes, if we see at opto would have also cleared all these metrics, but the one single metric that it would not have cleared is that it was consistently seeing a very strong high and a debt coming into the company. While if you look at Maharashtra Seamless, it has consistently just tried and decreased its debt. Now if a company can decrease its debt, it's unlikely that this type of a company is a company that is trying to cheat investors. It is sitting on substantial cash compared to what was at Opto. It also continues to see very good operating profit and net profit margin numbers. Would take you through Starlight Industries here itself. Uh, while looking at Sterlite Industries, if you look at Sterlite Industries as a ROIC minus WACC as a single entity, that is Sterlite only, you would see that the Sterlite Industries performance had not been had not been a very good number. If you see at the ROIC number, ROIC has been very weak. ROIC minus WACC was very weak for last 4 to 5 years. It has not been doing very good as far as value creation is done. While yes, sales growth has looked very good, but even the EPS has moderated. This is generally what would be a problem with an single focused and a resource industry. A major part of its revenue continues to come through, as far as Sterlite is concerned, comes through and its zinc and lead business. So this was a problem with an as far as an Sterlite is concerned. So if I look at Sterlite independently of and the fact that they are going to merge their company with Sesagoa, yes, Sterlite would not come out as a very good company. It would actually come out as a very bad company to really put your money into it. But when I look into Sesagoa as such, let me take you to Sesagoa. Now, if you look at Sesagoa as such, now the company's Sesagoa has been a consistent value creator. It has been creating consistently value consistently over last 10 years. Now when I do a merged entity look at Sesagoa and Sterlite Industries, I see that the outperformance of Sesagoa historically beats the underperformance of Sterlite, and because of the impending merger we are looking at Sesagoa and Sterlite as if it is a single entity, and because of this reason if you see our MRP for both Sesagoa and Sterlite is also continues to be nearly same, depending on the ratio at which the Sterlite shares will get converted into Sesagoa. So for Sterlite, it is a special case. We are looking at Sterlite as if Sterlite is a merged entity with respect to Sesagoa and Sterlite taken together, and not just Sterlite taken independently. This is one big difference in Sterlite Sesagoa compared to all other entities. So Sterlite independently value destroyer, but as a merged entity with the Sesagoa, eventually we are expecting that this eventually merging would should happen, should take place within the next 3 to 4 months. As a merged entity, it comes off as a good company. HDIL. Okay. There is one thing that we need to please keep in mind. I just remembered it. This metric, ROIC minus WACC, is applicable to only non-banking companies. For banking companies, it's not possible for us to estimate either the cost of its debt or the size of the debt that the bank has. So it's not possible for us to estimate its weighted average cost of capital. So this metric is specifically for non-banking companies only. Now, if we look at SDIL, now if you look at SDIL, we since it we as of now as a phase one we have implemented ROIC minus WACC for large cap companies. The mid cap companies and small cap companies should roll out by the end of next week. Tentatively at the latest by end of next week, you should be receiving a mail once this has been implemented by marketing team about once we have rolled it out for small cap and mid cap companies also. Now because HDL is not a large cap company, we have not implemented it for now. But just on a provisionary basis, if I look at the ROIC numbers of 9%, 10%, and 8%, you would and because of I look at the high level of debt that the company has, uh, I believe it would come out as a deep red company. Uh, Provisionally, we can look at DLF because the problem that an HDL suffers is similar to what DLF is also suffering as of now. See, the HDL will also run out to be something similar. Uh, since they are similarly in the similar industry, I would estimate that the WAC of SDI would also be somewhere around 15-16%. So for 2012 it would be a negative 6 percentage. For 2011 it would be somewhere around 3 to 4 percentage negative, and for 2010 it would be again about 5 to 6% negative. This is just estimated. My analyst will line up put up the WAC numbers for this, so the for final numbers can be a bit different. But the thing is that HDL would still come out as a color when I do a color coding of it with respect to ROIC minus WAC. It will still come out as a red number. Ideally, for a company that has consistently been seeing a value destruction, we would advise our investors to stay away from it. The only case wherein I would advise my investor to put money into it, even if it is a as seeing a negative ROIC minus WAC, is only if we think of it as a turnaround companies. It would be a high risk investment, and we can look into the company as if it is a turnaround company. Let's look at Opto Circuit. This is how we at analyst team look at a company like Opto Circuit. Opto Circuit has been an eye opener. Why we did catch it at above 120 rupees price, but since it was the company that we had recommended at initially for our investors, uh, uh, we are extremely it had left a very bad taste in our mouth because we want to avoid this kind of companies into the future. Now if you see, after circuit even using the current metric would have cleared and would have come out as a greenest of green company. On the sales metric also it would have come out as a greenest of green metric. But there is a new line item that we have added, that is looking at operating cash flow and its net profit. Now if you look at this row as such, if you see consistently, and this is something that you have to see every time you look into any company while making an investment, your operating cash flow versus the net profit has to be as close to its net profit as far as possible. Sometimes it's okay to have the operating cash flow bit lesser than net profit because the company may be going through a rapid expansion, because of which it is building its inventory and its receivables and inventories, because of which the operating cash flows have come down. But otherwise most of the times you should have that the operating cash flow should be as high as its net profit. Higher the better, but if less then it should not be more than 10% divergence from its net profit. But if you look at Opto Circuit, this single metric tells us that there is something fishy in this company, and because of this we are extremely negative on a company wherein whenever we see that a company like operate company which has its operating cash flow much more higher than its net profit. If I have Maharashtra Seamless, I'll take you through it in this to show you the same metric. because there was a question asked regarding Maharashtra Seamless. मेरे इसमें भी है तुला तर महाराष्ट्र मीटिंग मध्ये let's look at Maharashtra Seamless. Yeah. Now, if we see at Maharashtra Seamless, you see that yes, we see that yes, there is. It also seems as if the operating cash flow has been a bit negative than the net profit. The important part is to drill down why is this happening. So the reason this happens for a company like Maharashtra Seamless is because of the high level of investment and cash that it has, and because of it, it gets lots of non-operating income into its book. But once I adjust for that, the operating cash flows are as close to net profit as far as possible, and because of this reason we are not negative on Maharashtra Seamless uh, compared to opto circuit as such. Take NMDC also, and I will take PNB. PNB, please understand, sir, Nimish sir, it is a banking company, and this metric will not be applicable to a company like Punjab National Bank. It would definitely be applicable to a company like NMDC. I would take you through NMDC though. As far as PNB is concerned, Punjab National Bank is concerned, we continue to remain that Punjab National Bank, if you buy it somewhere around its DP, it will give extremely good returns. It will give end up giving extremely good returns for you. Just try and see to it that you do not buy it at a price much above its DP. Now, if I look at an NMDC also, it continues to see a very high ROIC, and its WAC numbers are also decent enough. It is still to get uploaded. NMDC, if you look at weighted average cost of capital and the weighted average cost, ROIC minus weighted average cost of capital, that is this row, you would see that the company continues to grow at a very decent pace. It is a good, very strong value creator. It has historically been a strong value creator that comes out of it, and a very strong profit margins. If you see it, profit margins itself are extremely high, 60%. And even though iron ore prices have weakened as of now, because of this strong profit margins, I am not much worried about NMDC as a company. If you look at sales growth, the sales growth has moderated over some time, but even if you see the large growth numbers that have come, the numbers are substantially much higher than what it is. Effectively, over last 10 years, the NMDC has grown its sales by 10 times. If you look at its EPS has grown much more higher. It has grown about 20 times, more than 20 times. So we continue to be extremely positive on NMDC. Again, over here, the recent red numbers that you are seeing is because largely coming out because of the other income that NMDC has. This other income is coming out because of the large cash that NMDC sits on. NMDC has about 17,000 crores of cash, sorry, about 18,000 crores of cash on it, and because of that, and much of it, it is required by government norms to put it into FDs within state banks, within PSU banks. And even if I assume a rate of just 8 percentage, about 8 to 10 percentage, it will translate to somewhere about 1600 to about 1800 crores to PAT that comes out as other income. And because of that, we see that there is a large difference in the net profit and the share price. But if I were to adjust that 1800 to 1900 crore rupees that it earns from within its operating cash flows, and then check whether it matches with operating profits or not, you will see that over long term, yes, it does matches with its operating the operating cash flow does matches quite comes very close to its net profit. So NMDC is a extremely good buy. As far as Gujarat NRE Coke is concerned, I would suggest people to just stay away from this company. There are lots of issues concerned with Gujarat NRE Coke, which are not just uh, while we would see this in the ROIC numbers also. again, it is a mid cap company. The WAC is not been put into, but just if you see at the ROIC numbers, and if I were to estimate decent enough ROIC of about 12 to 13 percentage each year, you would see that this ROIC minus WAC would come out as a very negative number. I would advise my fellow subscribers to please stay away from a company like ROIC minus WAC. Uh, Besides the fact that company has not been creating value for a quite a long time, the other thing that would keep me away from Gujarat Energy Coke is because of its very weak corporate governance, and people risk is one risk that I always advise my subscribers to always keep away from. We can always take business risk, but people risk is one risk that we should never take in. Yeah. Sometime in the month of February, about 14, in between 14th Feb to about 25th March, we had tried to bring in a buy sell plan. In the initial phase, we had introduced the buy sell plan for both green companies, greenest of green companies, as well as orange companies. But later on, we did a much more deeper level of research, and we realized that one buy sell plan will work extremely well only for greenest of green and green companies. It does not end up working well for orange companies. So one, we have removed orange companies later on, and in that we saw that we were too many buy signals were coming in, and the amount of investment that we were asking people to make into was extremely large investment. Rather than that, we have decided to come out with only two signals of buy and a strong buy as far as communication is concerned. And as far as uh, as far as the buckets are concerned, we have divided it into seven so that we can get the clarity of communication by keeping just two buckets, two symbols, that is buy and strong buy, while getting a benefit of smaller and SIP like investment done at on the basis of the fall in the value of share, so that we can start initiating purchase at a much more higher level than buying into the company at a lower levels. I understand, Arun, you would like to know about Hindustan Oil, but my analyst for Hindustan Oil is out of town. Just drop in a message to my customer care. I will see to it that I schedule a call with you, and he can uh, give reply back to your query on Hindustan Oil. Uh, there is a concern with respect to the fact that if you follow a buy sell plan, would you end up paying a very high brokerage level? No, actually no. I'll tell you why you would not end up actually paying a very high brokerage amount. One, we are not asking you to trade. It is not as if once the company moves from, let's say, invest up to 70 percentage, to from that level to it moves to, let's say, it moves higher, and I to say to a bucket wherein it we say invest up to 45. I'm not asking you to sell you're an additional 25 percentage. If I would have been saying that, then yes, it would have meant that we are asking you to actively trade and do uh, help your broker earn lots of money. We are saying that first thing that you have to do is decide how much amount you are going to invest into this company. So let's say Infosys is the case, it has fallen down by 20 percentage. Now I am sitting on, let's say, 2 lakh rupees of idle cash that I want to be invested into Infosys. Now how much should I invest into Infosys? Let's say you have decided that you will invest 2 lakhs, 2 lakh rupees out of it. The second question now is, should I start initiating purchase now? What ends up happening is, you see that it has fallen down by 20 percentage, you become greedy, we become greedy, we start thinking that okay, let it fall another 3-4 percentage, and then I'll go and put out my whole of 2 lakh rupees into it. Or it may happen otherwise, you may buy some amount of shares, you may buy your 2 lakh rupees shares now, but going forward about 2 to 3 days later, you will see that the share price has corrected another 2 to 3 percentage point, and you would lament that अरे यार और 2-3 दिन रुक लिया रहता. If I would have waited another 2 3 days, I would have got a much more it at a much more cheaper price, and I would have got much more shares for the same 2 lakh rupees price. So since we are going to invest the same corpus, whether we are going to buy it at DP or whether we are going to buy it through buy sell plan, your broker is going to earn only the return, only that much rupees that he would have earned either way, because we are investing just 2 lakh rupees. He's, let's say your brokerage charge is 1%, so he would earn not more than 2000 rupees, irrespective whether you follow a buy sell plan or whether you buy it at DP. Your broker would earn a much more higher money if it asks you to do a lots of trade, as in buy sell. That because of the buying and the selling activity, again doing it again and again, broker ends up earning more than what we end up earning. But if we decide to follow a buy sell plan, because the first part of the buy sell plan is to see to it that we make a credible buy, and only the second part is to see to it that we make a credible sell. And because of the percentage difference are much more larger, it is unlikely that a company will move from buy to sell again and again. So it's not likely that the company would see that we would end up paying a very high level of brokerage amount to the people, to our broker. For these companies, NMDC, EIL, Sesagoa, Sterlite, uh, what we are generally advising is that the resource based companies are as of now seeing a very strong negativity in the market, largely because of the weak resource prices in the market. But we need to understand that resource prices are not going to remain weak always. That's why it is always better to make investment into strong resource based companies like NMDC and Sesagoa whenever they are weak, they see weakness because of this. Otherwise we would miss out on investment into making into these kind of industries. uh, Please, we are not taking too many of stock based calls. The reason is because we would soon come out with a detailed subscriber webinar on 26th of April, in which you can put your stock specific query to us, and we will take each and every stock specific query regarding whether you should make investment into EIL or not. Cases like BHL and Maharashtra Seamless, we will take it into a much more detailed way and we can address it. This webinar was just to take you through the new changes that we have made in the 10-year X-ray, that is of bringing value creation met, metrics into this. Uh, Thank you. Uh, with this, I would like to bring the session to an end. If you have any queries regarding the stocks, please let us know. We would actively handle them. If please join us again on 26 when we would come back with stock specific queries. Thank you very much for joining us. I would